Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about something that I don't think is talked about enough. Now, I know that I talk about it a lot. I'm sometimes a broken record, but I don't really hear it talked about anywhere else, and that's on how to hedge correctly. Today we had a phenomenal example of correct hedging. Now, there's a lot of different ways you can hedge. You can buy shares in a stock that you like, and then you can buy an option as a hedge. You could use a correlated market and utilize that as a hedge. But what I'm talking about here is options hedging. A little bit of a different one, but the cool thing you can do, because there are different strike prices, there are different prices you can utilize to your advantage to buy and sell and trade as individual pieces, if you will, kind of their own markets. You can use them as ways to hedge a trade. Now today on Amazon, this is where we had our options trade for today. We actually had two different options trade because we took a hedge. Now Amazon was really range bound for the most part, and it looked like it wanted to drive down here, so I picked up the 1930 puts, the expiration of the weekly. They expire on the 28th. Here you can see the screenshot from the email. We're doing our small account challenge on Robinhood, and this is one of the trades that we took. So the limit order to buy one contract of Amazon at 1930 puts on 928 executed at an average price of $4.85. So I bought the puts at $4.85. As we can see, I was right for a little bit, and it would have worked out, and I think it went up like, I don't know, 20, 25 bucks from our entry point. Not really enough for me to want to take profit. I was looking more for like 100 bucks. I was looking for a rotation back down to the lows. But they ran into this brick wall of support down here, and it just didn't let up. And what we started realizing was very quickly that something was wrong. And when it starts moving back up like this, it failed that major support. We have a trap on the lows. There are some red flags. There are signs that something is wrong. And when that starts to happen, it's time to start thinking about what you want to do with the trade. Now, you can simply just exit, take the loss. You know, at this point in time, it was down, I think, 85 bucks or something like that. You could have taken the loss, and $85 for a loss, it's not really that big of a deal in the grand scheme of things, as long as your account size is correct. But the other option that you have is you can utilize the time appreciation to your advantage, understanding that the extrinsic value is still built in. It's not expiration yet. It doesn't expire until tomorrow. So it still has an extrinsic value, which is the value of how much time is left and a couple other factors. We're not going to get into the details of options. There's plenty of other videos that go over that. But we can use that to our advantage. So what I was looking for is I want to see this either prove to me that I am just dead wrong or that I'm right and it rolls back over again. That's why you don't see another entry until later over here. So we had a strong lift to the upside, and very likely with this amount of strength higher, it's probably going to get a second leg. But, you know, 30-40% of the time, it's not. So I gave it a little bit of time, starts rolling over, it's holding VWAP on the buy side now. Now we've got some issues, right? So now that we know that there is an issue, as soon as it popped up to a new high, that's my trigger to say either you're stopped out, you take the loss, or you look to hedge. In my personality, I like trying to give a trade as much time as possible. That's just who I am, going back to kind of the maximizing your profits mentality. But in this case, I'm wrong, right? And my job now isn't to make money on the trade. My job is to mitigate risk and loss, right? So one of the best ways to mitigate risk is just to exit the trade and take the loss. It's probably the easiest way. It requires a lot less thinking. But if you like a little bit more in your trades, maybe you're a big fan of hedging, or maybe you can trade multiple contracts. Our small account challenge, we started at $100. It's currently at $1,000. We don't have that capability of being able to, go in with 5 contracts at Amazon. It's just not there yet. So because of that, we had to take a little bit of a different approach. Now, again, you could just cut the loss and say, okay, well, I'm down 85 bucks, whatever, wait for the next trade. Or you have the option to utilize a hedge. So when, excuse me, when it pulled back to the moving average cluster here, after we had already reached our stop out point, I'm exiting either at a slightly better price, or I'm looking to hedge at a slightly better price for the buy side. So what did we do? Well, we look at the next contract that's trading volume. Let's go to the next one. Here you can see that we took, excuse me, let me mute Charlie in the background there. Here we can see that I bought the $2,000 calls, again, 928. Executed at $495. So I bought them for $495. I bought the other ones for $485, and now I'm basically hedged. At that point in time, my loss was around $65 to $85. And because when one goes up, it's appreciating in value, the other one is depreciating in value, it's basically a way that I kind of locked in my loss. There's not really, it's not going to be worse unless I hold it overnight, which I'm not planning on doing. So because of that, we created a situation that we now have the ability to limit our risk, but potentially completely erase our loss and potentially even make something on top of it, right? So what do we do next? Well, we wait. The market continues to go up in our favor, right? Beautiful breakout move to the upside. Amazon picked up a bunch of speed. And of course, in that time period, we see the puts that are depreciating in value, our shorts that were over here. We bought puts and we bought calls, right? So our puts are depreciating in value as it goes up, but because of extrinsic value and time decay not being as quick as the market has been rising, it's depreciating in an offset value. And that basically means that our losses that were essentially stacking up on our puts are being offset by the longs, right? Our long calls that we bought, the 2000 call options, are appreciating in value faster than our loss is appreciating in size, right? Now, I know that's a lot, and you might have to watch this video a couple times because it's a lot of fancy jargon. But basically, just think of it like this. My loss that I had on my short, right? I'm not even going to get into the option terminology because you might not be familiar with it. But the losses that it was accumulating on my short were going down slower than my gains were on my long, okay? Think of it that way. So when we start rallying up, it's catching some really nice movement. And there was an opportunity to get out of your puts at a smaller loss here and just stack your wins. That's fine too. I was mainly hanging on to it for an example purpose of the room so you can see what a correct hedge looks like, and that's exactly what we did. So if we go a little bit further in, what did we have? Well, let's go into where we exited. I exited my 1930 puts, the one that I bought at $485. I exited at $330, right? Okay, so let's start doing some math. Let's get the calculator out. So I bought them at $485. I sold them at $330. So I'm down 155 bucks, right? But I also exited my 2000 calls at $650, right? I bought those at $495. So although I'm down $155, right? So we're down $155. I bought the other ones at $495 and I sold them at $650. So guess what? I made $155 on the hedge. We netted break even between the two while limiting our risk to the downside. If the market goes against us and goes pile driving to the downside, we're still making money on the puts, we're losing money on the longs, and because of the way that extrinsic value works, your gains are going to increase as long as it's moving quickly, which Amazon tends to do. It's going to appreciate much quicker than your losses, and you can mitigate loss. You can get out even with a win. You can turn a trade completely around and make it a beautiful winning trade. In this case, we turned it into a break-even trade, but it's a fantastic example of what hedging correctly looks like, right? We got into the trade, it was working in our favor for a little bit, but then it just started going haywire and going aggressively against us. When we reached our stop out point, that's the decision that you can make where if you have a large enough account or you are okay with risk tolerance, you have the option, bad pun, to add a hedge of an option in the opposite direction. And that's exactly what we did. And by doing that, we completely mitigated the loss. We completely locked in our maximum amount of risk. We're never going to really lose more than $70 to $90 on it. It might go down a little bit more. But as one appreciates in value, the other is decreasing by an equal amount. It limited our downside drastically while opening the door to the upside to go absolutely nuts. It's a fantastic example of a hedge and a great execution. And just showing you that, even sometimes when you have the complete wrong direction, well, I mean, we were right for about 3 minutes. You can still make it work in your favor or completely mitigate risk altogether. Great example of it. And as always, hopefully, maybe you find it interesting, something you can maybe add to your tool belt or at least consider if you are an options trader or really any other kind of trader that's looking for possible hedge opportunities. So I hope you learned something. I hope you found it interesting or if anything, just entertaining. As always, underneath the video, click on the like button, give us a like. Along with that, click on subscribe and the notification bell icon so you're notified every time one of these videos comes out. We usually launch one every day unless something's going on, but usually Monday through Thursday, we've always got a video coming out. If you have any questions, feel free to send me an email, jbrink@slingshotfutures.com. Otherwise, I hope you had a fantastic trading day today. Really, just overall, we're starting to see some of the volatility come in, but it's not quite there yet. I don't know. Hopefully you had a great trading day either way, though. Enjoy the rest of your day. Rest up, and we'll see you all tomorrow. Thanks.